This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, my esteemed co-host getting ready to place Trade 1 in the Flat Earth Trading Society tomorrow, I believe. Right, Rob? It's Rob Reinhold.
Hey everybody, this is Rob from Maverick Trading, Maverick Currencies, and now the Reckless group of the Flat Earth Trading Society, where we pick stocks at totally random methods and we just apply strict position management. So yes, it is tomorrow, but by the time everyone hears this, we'll already have a trade or two in the bag. So I just posted a video on Sunday, July 30th about our exit rules. If you haven't seen that one yet, go look at it, and I go through the rules we'll be using for an exit. Should be fun.
And the reason I keep hyping up Flat Earth Trading Society, everybody, is because on this podcast, we do a really great job, I think, telling you and explaining to you what's going on in your head and giving you an actionable plan. But with Flat Earth Trading Society, you actually get to go watch it happen in real time, which is great because if you're ever confused on what to do, just go watch somebody who is taking everything we've talked about and putting it into action. Just like Rob said, recklessly going into this whole thing, but using discipline and using money management to turn it into what it is. It's a really great addendum to what we're doing here. Just like, I think, episode 36, Rob, is a great addendum to the things we've been talking about the last few weeks. So this is just really an extension of episode 33, 34, 35, but with a few more maybe anecdotes and a few more examples that I think can really bring color to everything we've been talking about. And then after we're done with this, we can finally kind of move on to something else. But I think there's a necessary reason for an episode like this. Rob, what do you think?
Yeah, I think we've spent a lot of time talking about all the negatives that can happen. And we really wanted to have an episode on some of the positives, because we're going to talk about this FOMO, this fear of missing out. That's a negative term that we hear, like, okay, it's a bad term. And we talked about it in Missing a Trade. That's FOMO. We talked about regret. That's FOMO. But now we want to really spin it to where it's like, hey, you know what? This can be a very, very positive emotion when it's used properly. So like I said, we just highlighted how it's destructive and how this emotion can really get you behind, but we really wanted to focus on all the great ways that FOMO can help you.
And so for a little bit of clarity, we talked about this before the show, I offered the idea of also adding not just the fear of missing a trade, but the fear of making a trade. And you said, no, we've kind of already talked about that in the past. Where's the difference between the two, just to set this up for everybody before we go forward?
Well, I believe that was in episode 6 when we talked about hesitation. We talked about hesitation, and in our Missing a Trade episode 34, we basically had to draw a very clear line between what is missing a trade and what is just random movements that we didn't participate in. And the line we drew was, did you chicken out? Did you build your trade? Did you run all the numbers? Did you build out the order ticket? And when you finally had to hit submit, did you chicken out? That is missing a trade. When the markets do whatever they do and the Bank of Japan comes out and says something and the yen spikes up and you're like, dang it, I knew the yen was going to do that. That's nothing. That's nothing. That nothing happened in your life. So this FOMO, again, fear of missing out. We talked about this in episode 35 with regret. Short-term regrets usually were a mistake you made. Long-term regrets were for an opportunity you didn't take. And that's really what I think we want to focus on today, Patrick, is the opportunities you didn't take.
Yeah, because that's the root cause, isn't it? It's fear. And just on a side, I think it was so funny you brought that Bank of Japan episode up. The one time in 12 years the Bank of Japan actually does something meaningful. The yen goes crazy, and everybody all of a sudden has FOMO now. It's ridiculous. But yeah, no, we're getting down to the root cause of some of the things we were talking about before. So I guess the main purpose of this episode is more so to bring up certain anecdotes that kind of illustrate what we're trying to talk about here. And then, Rob, you got some really good ones. I think better ones than I have. So go ahead and list yours for now, and then I'll jump in where necessary.
All right. So let's start off first with something that you have alluded to many times over this podcast. And we've used the term keep swinging. And in the last episode, Regret, we talked about, going on trading halts. And you and I disagreed on that. And you said, no, Rob, a trading halt is wrong because in my past, when I took, 4 or 5 losses in a row, it was the 6th trade that would have made me all my money back, and I chickened out. I blew it. And so you were very, very clear. And I agree with you 1,000%. The correct answer is to keep swinging. So let's reframe this FOMO in the way that you present it, because I think it's so beautiful. If you've now taken 4 or 5 losses in a row, if you cut your position size, if you stop, if you hesitate, that's the one. And guess what? I promise you that 6th trade will lose you more sleep than the 5 losers you had. Is that what happened to you?
That's exactly what happened to me, because at the end of the day, I'm like, I had this sense of dread because I'm like, okay, no matter what I do, I lose either way. I'm either losing money or I'm missing out on a winning trade. No matter what I do, it turns out to be the wrong thing. And so now a whole other plethora of emotions are taking over. And now, emotionally, I'm completely done, for the time being, which is not where you want to be, obviously.
Absolutely. So let's take this fear of missing out and let's reframe it in a positive way. You have just taken 4 out of the last 5 losses. Things aren't going your way. All those emotions you're going to start to feel. I actually want you to say, oh my gosh, statistically speaking, I'm due for a good winning streak. Now, before you just jump into delusion, I want you to go back to our episode we had on what to do during a losing streak. And the number one thing was to look at you and make sure that you aren't the reason for the losing streak. If you're the reason for the losing streak and you say delusionally, things are going to turn around statistically and you're doing all the wrong things, that is a disaster. And that's actually what most of us do. We live in this delusion. So I really want you to check and make sure that you aren't the cause of your losing streak. We also talked about sometimes the markets aren't conducive to your trading strategy. Check on that as well. Okay, I'm a trend trader. The markets have been completely flat and I keep clicking the button. Okay, maybe you should stop clicking the button because it doesn't fit. So make sure that you aren't the cause of your problem. Go back to that episode. But after that, you should be scared that you're going to chicken out and miss the run. Statistically speaking, you're due for it. It'd be so sad if you took all those statistical losses and you chickened out and missed the statistical run.
Well, Rob, that conflicts a little bit with the reason I chickened out in the first place. As a trend trader, I noticed, things aren't really trending. This is probably just the market I'm in, and I need to wait for a trending market to happen. So that's why I sit out. And then the trending market happens, obviously, and of course, because it's the very first trade of the trending market, I miss out on it. So what do I do in that case?
Go ahead and cry in your pillow. Look, that's the proper thing to do. When you take a look at what should I do when I do the proper thing, you did the proper thing. You should have some rules base that says this is what a sideways market is, and these are the measures it consists of. And during these markets, I either take less trades, I either reduce position size, whatever it is you determined, hey, in these kind of markets, I need to do this. If you did that, I don't care what the market did. I don't care if you missed out on 10 billion pips. I don't care because you did it right. You followed your predetermined system. So bravo, you nailed it.
And that was a proper answer, traders. Have a volume indicator. These things won't happen, or they'll happen a lot less. Okay, so I am looking at our outline, Rob, and I'm seeing some other really good examples here. One of them is fear of leaving money on the table, which I've alluded to a couple times in the past, but I think it's something that everybody experiences, so it really wouldn't help to bring it up again. And if you have any anecdotes on this as well, giving a little more color to a lot of the things we're talking about, I think this would be a great opportunity.
This should be a fear of yours. If you've tuned into the Flat Earth Trading Society, we are trading things totally at random. So look, I have no chance to increase my odds of winning based on my disciplined entry point. I'm kind of screwed. I'm just getting a stock or a currency, and I just have to go long or short. I don't have the benefit of doing all the things I know how to do to get an edge on the entry. So I have to be perfect on the trade management. And the episode we just did, we talked about no matter how much I try, I'm going to have some winners, some losers. I have what's called a 10 trade analogy that I share with every Maverick trader. You are going to study and work and do all this analysis on 10 trades. And no matter how good you are, no matter how much research you did, 4 are going to be losers at least. Think about that. The only trades you made are the ones that perfectly fit your system. And 4 or 5 of them sucked. Do you know how hard that is to deal with mentally? And not just 4 or 5 of them suck. 1 or 2 of them are absolute disasters. Like literally disasters. And then in that group of 10 trades, you have 5 that are winners and 1 or 2 are amazing. Here's the issue. When you click the button, you don't know which one it is. You think they're all going to be the best ones in the world, but they're not. Only 1 or 2 are going to be great. If you really want to win at this game, and that's what we're doing at Flat Earth Trading Society, is we're trying to cut off the 1 or 2 terrible ones. We know bad ones are going to happen. We're going to cut off those 1 or 2 terrible ones and just turn them into moderate losses. And we're going to hold on to those winners as long as we can. So you do want to have FOMO of leaving money on the table. It should drive your complete position management. That being said, what's more important is you follow your rules. So you basically should make rules for your system that allows you to stay in trades as long as possible. That should be part of your rules. And you have no control over when that trade actually ends, but you should have some rules and you should be fearful of cutting those winners too early, because if you don't get those 1 or 2 big winners, the numbers don't work out. They just don't work out. Even if you're a 50-50 or 60-40 trader, it just doesn't work out. So you should have that fear.
Well, just to be clear, there's another fear of leaving money on the table that goes the complete opposite way. So what I was talking about before, and tell me what you think about this, Rob. So I am a relatively new trader. I listen to all of VP's material. I listen to the Trading Psychology podcast. I love Robb's idea about trading in blocks. So what I'm doing is just that. I've done 3 25 trade blocks, and I'm hitting 17 out of 25, 19 out of 25. I'm Wolfgang frickin' Amadeus Mozart over here. I am the trading prodigy that this world just hasn't seen yet. Why on earth am I doing what VP and Rob say and risking 2% on a trade? How much money could I have had I had ratcheted that up to 3% or 5% or 10%? With a winning percentage like this, I'm leaving a ton of money on the table. It just doesn't make any sense to me.
I'm over here chuckling to myself because I don't know if you remember in the last episode, we talked about like, how do you know, how do you know you are dangerous to yourself after you've had a long winning streak? How do you know you're dangerous to yourself? Both you and I decided when you started to become delusional over what you could have made or what you will make in the future if you just would have done X. That is a danger signal. And that's what we said. When you start thinking about that, quit. You just put on the brakes because you are dangerous. So everything that you just said is complete delusion, where you're looking back on your trades and you said, I followed my system and I had these great results, but if I would have done it differently, I could have planned out my family's future. We literally covered this. When you have those delusionary thoughts, it is a red flag.
Okay, good. Just making sure, because everything we talk about here so far can have a couple different meanings. So it's important we define these terms as we move forward, because we will be moving on to other things after this. I just want to make sure that everybody's clear.
And what you just said, it is a type of fear of missing out. As we're talking about FOMO, the fear of missing out of what I could have made had I done it differently. That is a negative usage of FOMO, and you absolutely need to be on guard of that. But let's keep talking about ways that we can use FOMO to actually increase the ability for us to follow our plan and follow our system. So we've talked about fear of missing a move, and we talked about, hey, the big run is coming. The streak is coming. It's around the corner. Don't miss it. You've got to have enough ammo. You got to have enough capital to take advantage of it. So don't lose your capital when you're in these sideways markets and things. You got to be excited about keeping swinging. And number two, we have the fear of leaving money on the table. We have the fear of, okay, we just discussed that. You should be fearful of that. You should develop a system that actually tries to get as much of that gain as possible while staying disciplined. Now let's talk about some broader things, because this is a big one to me. And I want to tell everyone my worst trading story. Now, I started trading in 1997, and I started day trading stocks, and it was pretty good. And I fell in love with shorting. I just loved shorting stocks. I thought it was way easier to make money on a crappy stock than to, everything seemed to have to go right for a good stock. Like the economy had to be good. People had to like the president, and everything had to be good. And then when I looked at shorting, it's like, look, everything could be good. And if this one stock had one negative thing, it dropped. And I thought to myself, it's so much easier to short than to go long. And so I did pretty well those first 2 years. And then all of a sudden, stocks just kept going up and up and up and up, and especially .com stocks. And I watched these things, and all these people that were just barely starting trading, they were jumping in, and they were making a ton of money. And I was saying, this is not going to end well. And it kept going, and I said, this is a bubble. I knew it was a bubble. I was so incredibly convinced that it was a bubble. And I watched all these other people making all this money, and I said, I'm not going to be the idiot. I don't want to be the idiot buying these stocks because I know they're going to crash. And I was so convinced, I actually took shorts in September, October of 1999. Plus, I don't know if you're old enough to remember, there was a Y2K thing where the end of the world was going to happen, but I thought, oh man, this is a no-brainer. And so I took a short. And I chose one stock, Phone.com. Now let me tell you about Phone.com. Phone.com had zero recorded profit ever. It also had zero recorded revenue ever. It also had zero products to sell. But the people that made the company had an idea that they were either going to make something with a phone or something with a computer, but they didn't know which, so they just called it Phone.com. This stock came public at 20, and at $100 a share, I thought to myself, this is a no-brainer. So I took a big short position because I was way confident. Remember, I knew that this was a bubble. Because I was so confident, I didn't follow my position sizing, and the stock went against me. So I got short with a big chunk of my account, right around $100, and at $116, it started to get painful. Ugh. Now, granted, this thing moved 5 to 10% a day, so it's just really fast mover. So I took a little bit off. Next thing I know, a couple of weeks later, it's at 150. I had to take some more off. And at the very end, I had to be pushed out by the margin department at $216.05. I still remember that exact price. That stock went well over 300 before it tumbled, and I was right. I was completely right, but I blew it. Now, I thought, oh, that stupid stock, this stupid market, this stupid everything. No, it was me. It was me. I blew it all. Everything that I had done to get up to that point, I threw it away. Why? Because I was so convinced I was right. I had to learn that lesson. I lost 86% of my account. Looking back, I realized I had to go through that to really understand, I don't care if I'm right. I just want to make money. I just want to make money. Now, look, it's taken me a long time to get to where I'm at. I've been doing this now for over 25 years. So the next time a bubble formed was in, 2006. And if you remember back then, oil was up to $150 a barrel, and everyone was making all this money off oil stocks, and the market was great, and real estate was crazy. And I remember thinking, wait, I saw what happened in 1999. This is a bubble. But I was too scared to get in. But the great thing was, I was also smart enough to not short it anymore. I'm going to wait to short it when the market goes down, which I did. I waited till 2008, and I actually had a very good 2008. But from 2006 to 2007, I didn't have very good trading years. Why? Because I didn't want to be the idiot. I didn't want to get caught up in that. So the market crashed, And then I thought to myself, I was so smug thinking, oh, I didn't buy in like all the idiots, like all the dummies. And then I finally kept thinking about it and I realized, wait, I didn't make money for 2 years because didn't want to be looked at as stupid and didn't want to be a lemming like everyone else. And then I realized I'm the dummy. So I took what I had learned, and I said, when the next bubble comes, man, I'm going to jump on it and I'm going to make a ton of money. And I have had my best trading years over the last 6 years, and it's because I was a dummy. Now, here's the thing. I know how to trade now. I know how to properly position size. There was nothing wrong with my trade in 1999, except for position sizing and position management. So I knew it. I said, hey, look, if this is near the top, I'll just get out. I won't get out at the top. You can't, but I'll get out. So over this last 5-6 years, it's been fantastic. The GameStop thing, all the penny stock things, I was right in there participating. But I did it with very defined rules of position sizing and position management. And 2021 was my best trading year ever, and it was fantastic. Why? Because I'm now scared of missing out. I'm now scared of missing out on the next Bitcoin. I'm scared of missing out on this trend in AI. I'm scared to miss out. So I'm really using FOMO to drive myself forward to be in the right places at the right times.
So a real quick story along those lines, and then I'll kind of get into a solution to all this, if it's not already obvious. But there's a company that's been around for about 5 years. And it's funny because they uplisted, but I don't know why, because this company has not made any money for the last 5 years. On top of that, the owners and the CEO have all gone to jail for fraud because I think they fabricated records on a contract they had with the Air Force that they didn't really have, and so they said they had all these earnings, and they went to jail for this. Yet the stock just kind of sat there. But the stock is getting a lot of money put into it right now. I can't remember the name of the company, but I do know the ticker symbol. Rob, any guesses of what the ticker symbol might be?
I don't know this one.
AI.
C3 AI.
That's the one. And never had a solvent or profitable day in its entire life. Yet it is all the rage right now because of the ticker symbol it had the foresight, I guess, to have 5 years ago. So it's just one of those things. The market can stay irrational longer than you can stay solvent. But that's the whole thing about what you just talked about. When we make fun of these people who just jump into these things and get dumped on and just get wrecked, it's people who don't have any predetermined plan going into it. If you do, it's actually okay to chase these things. The example I give on my investment podcast is on the investment podcast, water seeks its own level. So everybody who pretty much listens to my podcast, we all agree that bad times are coming and we need to prepare ourselves for that. But when you do that, you're always going to be too early in most cases, and you're going to miss out on a lot of these runs like you talked about. But you don't have to voluntarily not participate in them. Almost everybody who listens to my podcast are also traders. And so they know what to do. I said, if you want to jump into AI or the NASDAQ or something like that and trade it, because obviously your charts at some point told you to go long, well, then go do that. Why do things have to be so binary? You can have your cake and eat it too. You can prepare for the worst, but also take part in these things so you're not left with this regret like you were in the past that probably affected you later down the line. Fair to say?
Absolutely, Patrick. Over all the years I've done this, I've had to learn so many lessons. And let me tell you the thing that I am now by far the most proud of as me as a trader is that I no longer trade my opinion. Think about that. I can have an opinion that this market's too high. I can have an opinion that the Swiss franc that's running lately is stupid. It's the dumbest thing I've ever seen. I can have those opinions. And I can actually go long Swiss franc. I can have the opinion that we're in a bubble and it's going to pop and go long. I'm so happy, and I've worked so hard to where I don't trade my opinion. I just trade my strategy. And here's the crazy thing. When you start to grow your wealth and grow your money, you now have separate accounts that have different strategies and different objectives. There's been many, many times where I've been long in one account and short in the other. And again, it's crazy because, hey, the stock market goes up, one account goes up, one account goes down, and then vice versa happens. But the reason is that they all are trying to capture different things with different time frames and different strategies. And you have to be able to separate out your opinion, which is very binary. It's either going to go up or down, to, hey, it's going to go up a little bit here, but I think over the next year or two, it's going to go down. So I'm going to prepare this stuff over here for when it does go down, but short term, I'm going to be long here, so I'm not missing it. You can do that. It's very, very difficult. It takes a very long time, but I want to throw that out there for you to start thinking about, okay, how can you think in complexity and think about different time frames and different areas? Like Patrick, you can be absolutely very bearish long term, but you could be wildly bullish short term if your brain will allow it. Most people's brains won't allow them to have a long-term pessimistic view and have a short-term action where they're actually going long aggressively in stocks and currencies, whatever. That's very difficult. I advise everyone to work their way to where you can actually do that because it is liberating. Now you just trade price action, and we call it cocktail talk at Maverick, meaning whenever Patrick and I talk about the market, how we see all these problems with the banking system, guess what? That's best done with drinks in your hand late at night and laughing about it. That should have no place in the trade you're making right now.
So as you've probably figured out, we're not telling you anything really new in this episode. We are just throwing out some real-time stories and some anecdotes to try to give color and illustration to some of the things we've talked about in the past. So we hope it was entertaining. We hope it was helpful. And so on that note, thank you everybody for listening to episode 36 of the Trading Psychology Podcast. We will see you next week.
Goodbye, everybody.